What's going on, everybody? So, my name's Lamar, and today I'm going to be starting a free course on YouTube on how to become a profitable trader without paying $1,000 for someone's knockoff explanation of RSI. And this is lesson one. Lesson one is going to cover market structure. And I want to go through this as swiftly as possible because people these days do not have large attention spans. So let's cover it in 10 to 12 minutes would be ideal. If you like this video, I'd appreciate a like. If you have interest in following the remaining lessons, you can follow me at Confluent Trading on YouTube. So to begin the lesson one market structure, we are going to cover supply and demand. The market is continuously hunting for a fair value. It's just, that's why you will see the market oscillate over and over again. And the currency markets, it just back and forth for year over year. And the market oscillates because it's trying to find a fair value. And it's hard to find that fair value when the underlying dynamics are always changing. But we as technical traders don't have interest in the underlying dynamics. It's printed on the chart. The fair value areas have been printed on the chart, so we have the historical data. If demand outweighs supply, then price is going to move up. That's pretty simple. More buyers than sellers, price moves up. If supply outweighs demand, then price is going to move down. More sellers than buyers. The dominant force can be identified by market structure. Market structure is the most crucial part of trading. I believe if you go to any trader in the market, they will agree that market structure is the most important piece of information that the market can print for you. It prints it for you on a daily basis, and that is the schematic that you need to follow and you need to always take into account when making a trade. So the trend is your friend, and that really just means the market structure is your friend because the market structure is what generates a trend. Simple statement, but wise statement. So supply and demand. Here is a real example of how supply and demand moves. So bullish market structure is a series of higher highs and higher lows. So on the left, I've got schematic of bullish market structure, and MS just stands for market structure, short for market structure. So as I move up and I make my first higher high, price runs into supply. You have sellers in this area. As it pulls back, you run into buyers. Buyers that feel that a higher price is now a fair value. As we move back up into that high, and we breach it, that means we've exhausted sellers at that price. The sellers who were selling at this first high, they're no longer interested in selling. They've seen the buyers come in and begin to mark up the value. So we make a higher high, a higher low, a higher high, a higher low, and that is the formation of a bullish market structure. On the right, you can see what I refer to as a clean bullish market structure, one that is very apparent, which has a lot of order to it. No real way to question it. It's presented itself properly with order and precision. And you're not going to see this in all cases, but we've got the same schematic: high, low, higher high, higher low, higher high, higher low, and higher high, higher low. So it's the same schematic over here, just in real life. This is what happened to Chainlink United States dollar at the beginning of 2020. So moving on, bearish structure is the exact same thing. It's just flipped on its head. So bullish market structure is a series of higher highs and higher lows, where bearish market structure is a series of lower lows and lower highs. As you move to lower lows, the buyers come in and they begin to try and hold that value, and they move up, but sellers feel that price is getting marked down. It's lesser value. So you have supply coming in. And you push down again, demand steps in. You rise up again, and supply comes in. So this is supply and demand forming market structure. On the right, we also have Chainlink versus the United States dollar. And this is, I believe, the later date, but nevertheless, this is clean bearish market structure. I've got a low, I've got a high, I've got a lower high, and so forth and so on. And so you can see the clear trend of the market presented in a very orderly fashion. This is bearish market structure, and this is how supply and demand plays into forming market structure. Market structure, time frame confusion. So this is what I struggled with the most personally when I first started trading. You look at so many different time frames, and you don't know what time frame you're really looking at. And what you have to do is recognize that the different time frames can be in different market structures simultaneously, and you have to practice identifying that. So avoid time frame confusion. Find a chart, identify what trend the H4, which stands for 4-hour time frame, identify the trend, the market structure of the 4-hour time frame, and then within that trend that you found, identify all the points where the 15-minute market structure was changing trends. So the 15-minute market structure can be in a downtrend while the 4-hour is in an uptrend. And that's how time frame confusion can begin. So you have to practice this by identifying one chart at a time and marking it up. Just because the H4 is in an uptrend, it does not mean that the minute 15 is in an uptrend. When all time frames are showing the same direction market structure, you have an edge. That is crucial. When all the time frames are showing the same direction market structure, you have an edge. You want confluence in your trade. If you wanted to trade with the trend is your friend, then the best possible setup you could find is if the daily time frame was in a bullish market structure while the 4-hour was in a bullish market structure, and then you made a trade based on the 15-minute or the hourly, and guess what? Those were also in a bullish market structure. So you have all time frames aligning with the direction of the market that you're trading. And that's going to give you the largest edge to trade with a trend, to trade with the dominant trends. It's an edge that is just absolutely invaluable, and this edge is going to be how you keep trading simple. And you don't have to have 7 indicators on your chart. In fact, you don't have to have 1 indicator on your chart. Trading with market structure is everything you need. So, simultaneous bullish and bearish market structure examples. On the left, I've got Chainlink versus United States dollars. It's making its move up. We can see we're in a 4-hour bullish market structure. And we've got a low, high, higher, low, higher, high, higher, low, higher, high, and I've got the yellow circle. So bullish market structure 4-hour. Within this yellow circle from this 4-hour chart, here is the zoom in, like I'm putting the microscope on. And now I can see into what's happening within that price action. And this is the 15-minute time frame of Chainlink USD. And you can see I've got a bearish market structure. So I've got lower high, lower low, lower high, lower low. And the best trade one could take is when this 15-minute market structure turns back into a bullish trend, which would align it with your 4-hour market structure. Now your 4 hours bullish and your 15-minute shifts back to bullish. And I'm about to show you how to identify the initial shift in market structure. Well, when that 15-minute aligns back with the bullish market structure, now you once again have an edge. You have the trend behind your back. So identifying market structure on any time frame, it's the same for all time frames and how you identify shifts in market structure. On the left, I've got Chainlink again, and it's the same images we just saw, that 4-hour structure. So here is the market moving up, and at this 15-minute time frame, it's moving up. It's got bullish market structure. The first sign that the market is weak in its trend is when it breaches one of the previous lows, and that's specifically for a bullish market structure. When it breaches one of these previous lows, we get this first red circle. We have now breached the low, and a key thing for me to note is price has closed below the low. Not just leaving a wick on a Japanese candlestick. It is closed below the low. So now we have our first breach of structure, and then a lower high, and then a lower low. And now, as a trader, you have all the confirmation you need for this last lower high to trade it. And there are going to be traders who want to take this first short. You know, we breached that low, we come back high, and they're going to want to be shorting early. The earlier you short, or the earlier you enter a position, the less probabilities you have, but the higher potential rewards you have. So you're going to lose more of the trades, but you're going to get higher reward out of the setup. So it's up to you how much risk you really want to take on that. The smart thing to do when you're beginning trading is wait for the market structure to be clear. And so I would wait for this lower low to form, and then you would be taking that lower high short. Now, bearish market structure is the exact opposite. We got a low, we got a lower high, a lower low, a lower high as we perceive it at the time, and then price comes and holds this low and moves up, and now we've breached the high. We've done the exact same thing here. We breached this higher low. Now we breached this lower high from this bearish market structure. And so now you get your first signs that the market may be shifting in trend, and then it does proceed to make a higher high. And I'm cherry picking these examples, but I'm telling you this happens all the time. Every day you can find these trades. You have endless markets to trade, and they all operate based on supply and demand, which is what forms the market structure. So looking for that first low to be breached or that first high to be breached, and now you've got that potential shift in structure. Support and resistance found in market structure. Market structure generates great support and resistance that's going to offer a good trading opportunity. As market structure forms, it creates levels of support and resistance. Market structure can form on all time frames, like we discussed. It's fractal. They can occur on the daily, the monthly, the weekly, the hourly, and it's going to look, market structure is going to look the same. But the higher the time frame you go on or you operate on, the stronger the support or resistance levels are going to be. So if I'm operating on the 4-hour or the daily charts and I'm seeing resistance or supports on these levels, then they're going to be or have more integrity, have more probability of holding. And that's the whole game. It's probability. So they're going to have a higher probability of holding on the higher time frames, lower probability on the lower time frames. These levels are where we're going to look for entry, but that's going to be covered in greater detail later in the course. Long support and short resistance. Very simple concept. This is where market structure comes into play. On this bullish market structure, price moves up, we make a high. Price holds a higher low. Price breaches the previous high. This is where supply came in before, right? Supply pushed us down. Demand held the market up. Demand pushed us through that previous high. And now you look for what is called support and resistance flips. Generally, what you're looking for is previous resistance, which would be here, to turn into support if breached. And it's called trading the breakout retest. So you're trading a retest of the breakout of a resistance. And that's what happens here. You see market retest perfectly, moves up, breaches this high, comes back, retests perfectly, moves up. There's a little red arrow. I took that trade today, and it was successful, but I didn't let it ride. It's Friday. Bearish market structure is the exact opposite. And you can see price makes a low, a lower high, breaches that previous low, comes back, retests perfectly, breaches that previous low, comes back, retests perfectly, and then eventually this shifts structure. But this is the idea of support and resistance flipping. Price coming to retest those breakouts. And this right here on this screen, you are looking at the whole trading system. You don't have to go learn 1,000 things that are pull up 7 indicators and wait for them all to line up, and the moon aligns. The moon aligns and everything aligns, and then voila, now all of a sudden you make money. No, it's pretty simple. It's just a matter of risk management and market structure. So the imperfect market structure, this is what I have to cover because everything so far looks pretty easy. Well, it's not always perfect, and that's something where your stop loss placement is going to be important, your risk management is going to be important, and your understanding that of actual how market structure shifts, because you can have breaches of these zones, these support and resistance, yet you still haven't changed market structure. So that's going to be our example here. All the examples provided thus far have been ideal market structure. Not all market structure is clear. Not all support and resistance is precisely respected. The following slides will present imperfect yet completely valid scenarios. Imperfect market structure. On the left, I have an imperfect bullish market structure example. This is chain link versus the United States dollar after this last decline, after the economy crashed because of the coronavirus, and it was recovering. And you can see it's very choppy. It's not as clear. And then as we're making these higher highs and higher lows, look at these red marks. Sweep low. So basically, price did not end up closing below these previous higher lows. What it did was a giant sell order came through and it swept below all those previous higher lows. Yet market structure stayed intact. Price got bought right back up above those lows. And we can discuss this later, but what it basically did was everyone who was in a long is now stopped out, pretty much, if they're trailing their stops. And it generated a lot of liquidity in an illiquid market, but that's for a separate conversation. So it sweeps the lows, comes up, fails to make a higher high, but then holds higher lows and continues. So this is an example of where you've got market structure, where it's not making as violent of moves past each previous higher high, yet it's still bullish, and you're having a few deviations that appear as if there's weakness in the market, but then it proceeds to make a new high. So this is an extreme version of what choppy market structure is. Not fun to trade. I would suggest finding a different asset during that period. Imperfect bearish market structure example is same thing. We're making our lower highs, our lower lows, and then here is a sweep of that previous lower high, another sweep of this high, and a higher low held here. Once you push up, you're almost thinking maybe I'm getting a shift in structure, and then the market continues lower. So these are two examples of what can happen very frequently in regards to market structure. Trying to find a clean chart is what your job is. You have endless things to trade. Why would you trade something that looks like doo-doo? It's not worth your time. Go move on. So the imperfect support and resistance level, imperfect bullish support. Price makes the high, breaks down, makes the higher low, pushes past the high, and you can see it does not hold this low. It actually sweeps through it, comes back and reclaims that low, and then continues on. So if you were to take a long here and have your stops right below that demand zone, you would have probably been stopped out unless you had your stop loss below market structure, which would have been the ideal place to have it. But you can't always do that based on the risk reward you're trying to obtain. That's separate. Imperfect bearish resistance, you can see it does act as resistance, but the price breaches the horizontal resistance here, and it breaches horizontal resistance here. So potentially you're stopped out of those trades too. This is where risk management, stop loss placement, all these things are key in order to trade. But there's examples of where it doesn't work perfectly. Conclusion, trend is your friend. No question, market structure is your friend. Market structure is the most important information that the market can provide to you. It provides you early indications of trend changes, the direction of the market, the strength of the market. And the strength of the market is really presented by how well it's holding those resistance and support flips, how tight the market structure is. Is everything very orderly or is it sloppy? That's going to be a representation of strength in the market, or weakness if it's bearish. But you can trade short or long, so it doesn't matter which direction it's going as long as it's orderly and you're able to profit from it. Market structure provides you entry and it provides you calculated risk opportunities. That is the most important thing. There's going to be a whole video covering that, but every time you trade, it needs to be off of a calculated risk. And that's the type of setup that market structure can present to you. So that is everything. And that is lesson 1. In lesson 2, we're going to cover how we can identify levels. And identifying levels is great. And it's crucial to add in confluence with this market structure concept. And you really aren't going to need 100 indicators to trade. You are going to be able to trade. I pretty much just presented you the entire trading system, but we're going to really dig into it and how to execute it properly, and how to manage your psychology and your emotions, and just how you're going to change as a person. If you actually want to become a great trader, then you're going to change. You have no idea how inefficient, how inconsistent, how emotionally driven you are today. And trading exposes that in all of us. There is no way around that part of the process. You have to do it. So thank you. If you enjoyed this video, follow me on Confluent Trading, like the video. I appreciate all the support, and y'all have a great day and good luck with your trading.